Thank you for joining Celiac Canada tonight on our webinar, How to Leave a Legacy While Saving Taxes. I'm Melissa Secor, National Executive Director for Celiac Canada. Pleased to be your MC tonight. And I'm joined behind the scenes by Tim Odette, our Development Coordinator, and Stephen Hubley, our Development Manager, who we just asked to turn his camera off. They'll be behind the scenes tonight. Just before I introduce our speaker tonight, I just want to address some housekeeping notes, how we typically do the webinars with Celiac Canada. First, you're all on mute, and this is simply to avoid unnecessary background noises that'll impair anyone's ability to join and learn tonight. If you have a question, please use the Q&A box. Don't use the chat. We will then line up questions as we go. Feel free to post the questions when you think of them. We can ask Jennifer at the end of the session. Jennifer, unless you wish us to chime in when there's a pause, we'll find out when she gets started. This is being recorded and transcribed. So we will send you a recording of the session. So please just note the kinds of questions and identifiers you wish to share with us. You know, other people will be seeing tonight. We will stop the recording at the questions just so we can give people a little bit more privacy or intimacy to ask some of those extra questions. We can do some follow-up questions and we can take people off mute for some follow-up. We just confirmed with Jennifer. Tonight should be considered advice or informational, and everyone's encouraged to speak with your own legal counsel. Or, of course, if you're interested in what Jennifer's provided, you're welcome to contact her directly and make an appointment for specific legal counsel. I'm sure she'll share her details, and we can include that in the follow-up email. I don't believe there'll be some storms or electrical power problems that will cut me off, but we got Timothy ready on backup duty in case you lose me and hope we don't lose our speaker. And finally, just want to thank you all for your commitment and support of Celiac Canada. We're a very small charity and the only national celiac charity in Canada that supported the community for over 50 years. We were one of the first in North America for celiac disease. Our vision is to see a world without celiac disease, and we are supported by 10 great chapters across Canada that offer local supports. We have launched a new strategic plan focusing on finding, treating, and curing celiac disease, and you may be familiar with our advocacy efforts to bring affordability to Canadians living with celiac disease and other novel programs. It's a small charity. A legacy can be transformative for an organization like ours. And for our charity, it doesn't have to be millions for larger charities or hospital foundations who receive regularly multi-million-dollar endowments, but we would love them. For Celiac Canada, a $5,000, $10,000, or $25,000 gift could mean the difference between saving or expanding a program or having to cancel it, maybe like growing up celiac, hiring an additional registered dietitian to support the community with dietary resources or life-saving call on our help desk, funding the next big breakthrough, which we have done in Canadian research on the disease through our James A. Campbell Research Grant, the only one of its kind in Canada dedicated to Canadian celiac research. And finally, it could mean providing a research grant to an early career researcher who needs their first opportunity to get started and then decides to dedicate their life to celiac research. And it has happened. So as you listen to our speaker tonight, please consider how you might leave a legacy to a charity you care deeply about and how it has impacted your family on a daily occurrence like celiac disease. But also you can save your state some critical funds to support your family as well. You can do both, support your family and your passion, and we'd love to be your charity of choice. So with that, I'm going to introduce Jennifer, our speaker tonight, Jennifer Stebbing. Jennifer is a recent past president of Celiac Canada, and so she's one of us. Jennifer was an incredible asset on our board of directors. She's the owner of Stebbing Butcher Law Firm in Brantford, Ontario, and Jennifer's one of the first and only to carry a very specialized certified specialist designation in estates and trusts. And it is her claim to fame that she is the only lawyer to carry such a designation combined with 3 law degrees, which includes tax. The trust and estate practitioner designation she has recognizes professionals with expertise in inheritance, succession planning, estate administration, and trust, where these individuals are held to the highest standards for ethics, continuing education, and professional conduct. So she knows what she's talking about, and we're fortunate to have her sharing her time tonight. So over to you, Jennifer.
Awesome. Thank you, Melissa, for that wonderful introduction. And it's great to be back doing something with Celiac Canada. It's been a couple of years since I've been on the board, and it's nice to be able to continue to give back to an organization that means so much to me. And I think to echo what Melissa was saying, I remember being on the board and being, because we get advised when there's donations coming in, and being told about a gift someone left us in their will. And it just meant so much to us as a board and as an organization to have that large donation. Like a lot of the donations for the Celiac Canada are all small from all of us, giving a little bit as we can while we're alive. But that legacy gift is usually a catalyst for change for us. We can all of a sudden afford to do a big study that we wanted to do, or to finally implement a program that we wanted to, but we didn't have the seed funding to do it. So it's something very important to me personally for this organization, but also as an estate lawyer and estate planner and that kind of work. Just being able to know that that gift can make such a big difference for an organization. So just give me 2 seconds. I am going to get my PowerPoint on the screen and up. There we go. We should be good now. As Melissa mentioned, there's a Q&A button in your Zoom there, so you can put your questions in there. Feel free to put them in there as you think of them, because we'll go over all of them when we get to the questions section. Again, as Melissa mentioned, we'll stop the record at that time, just because I find it works better for a conversation at that point, just to know that it's not going to be out there in the internet forever, the questions that you're asking me. But today, we're talking about how to leave a legacy. While saving taxes, because who doesn't want to save taxes, right? And so I'm Jennifer Stebbing, one of the owners of Stebbing Butcher PC in Brantford. Main part of my practice is estate planning, wills, powers of attorney, trusts, all of those kinds of things. And I do have a master's of law specializing in tax, which is why I enjoy talking about these things, because I call it, we're being tax efficient. I'm not trying to evade or not pay what's due. What we're doing is using the tools we have within the system to make sure that you can do the most you want to do with your money. So now for my disclaimer section. So I'm a lawyer licensed in Ontario, and I'm not providing you legal advice today, because legal advice is something I give to a client in my office one-on-one or two-on-one if it's spouses. So this is for informational purposes. Take this home with you, think about it. If you have more questions, contact your lawyer or reach out to a lawyer, and then you can have that more personal conversation and the legal advice that's more tailored to your situation. The other thing to know is that we are in a public situation right now. So even when we get to the Q&A, even though it's not recorded, there's no solicitor client or lawyer client confidentiality or privilege, because it's of that public situation. So I don't mind if any question says, I have a friend who, or I have a brother who, or something else. You don't have to ask a personal question and say it involves you necessarily. But today, I'm going to talk about charitable giving in a will. I'm going to talk about legacy giving. What is it? Why do we do it? Some myths about it, what holds people back. I'll also give you a little bit of background on what is a will, how we do it, how all of that works, how you leave money to a charity in your will and the different options. There's actually ways you can leave money to a charity outside of your will, so still post-death, but not within your will. And then some of the tax implications that exist out there. So why are we talking about legacy giving today? So Canadians donate over 10 billion a year. That's a lot, right? But it's fewer than 10% of us leave a gift in their will. And so that's the big shift. A lot of charities, and there's actually a campaign that charities gotten together called Willpower, to talk to people more about it. If you give that much to your life, how come we're not seeing the same gifts carry on after you've passed away? Why is it not the same percentage of your income that you're giving? Which is interesting research, but we don't have that answer from people. But if you are curious, if you Google Willpower, it's a Canadian campaign. And on that website, you can actually play with what kind of gift you would want to give. And it would actually have a calculator on that for you. to show you what your tax refund might be on your estate. So that can help you really when you're trying to figure out if you want to do it, how much you want to give, how you want to do it, because it'll help you figure the math out for you and you don't have to do it yourself. Legacy giving can amplify your impact without reducing your lifetime resources, right? So you don't donate during your lifetime because you don't know how much you're going to need while in your retirement. But if you do it in your will, you've already used everything you need. And so you can do it in there without affecting your lifetime. It can provide tax savings for your estate. And legacy gifts, the way I like to think about it, you can give twice. So you can give to a charity and help them, but it also helps your family and how much they're getting from your estate because of the tax savings that you're going to get back. So, what is legacy giving? So, it's donation made by an individual through a will or other formal designation. Formal designation means like a beneficiary designation, and I'll get into that later. It's also known as planned giving. You might see that on online as well, or you might see stuff coming from other charities that say planned giving instead of legacy giving. It all means the same thing. It's just when you're donating to a charity through your estate plan. So why consider doing it? You might be able to fulfill some personal values or passions. You can make a lasting difference. You can support causes that may have helped you or your family throughout your life. And of course, the tax advantages to benefit you and your heirs. So some of the myths. So some of my clients, when they're thinking about this, they're like, well, if I give to a charity, that means I'm giving less to my family. And it's like, well, that might be true depending on the gift and how it's done. It may actually net out that you haven't given them any less at all because of the tax refund, or net out it may be like you're only giving them 25% less total. It kind of depends on the situation and what you're doing and what you're giving, what the end tax result is. But it's not 100% ever. Like if I'm giving $100 to a charity, then my loved ones are getting $100 less. Some people talk to me and they say, I'm not wealthy enough to leave a gift to a charity. Um, and I tell people something that Melissa just told you. Even the smallest of gifts makes a big difference for a charity. $1,000, $10,000, $100. It makes a difference, especially for those smaller charities. What you have to realize is like the big charities out there that we hear about all the time, like the Canadian Cancer Association, Red Cross, or your local hospital foundation, and things like that. Those are big charities. They're getting those big dollars every year. But the vast majority of charities, like there's so many of them, are actually on that smaller side, and they either have a very local impact or they have a very topic specific impact, like Celiac Canada's topic specific for celiac. So other people think it's really complicated, but it's actually fairly simple. When I'm doing wills, it's not an extra fee or anything like that to draft those kind of clauses. It's relatively easy for me to do. Sometimes the hardest part for my clients is actually choosing which ones, or if they want to do to like 4 or 5 instead of just one. It's them like making the list is the hardest part, but it's not hard for me to do it all. And some people are worried, like, well, I already have a will and I have to pay to change it, or am I going to have to do a new one? There's lots of options with that too. You can do a codicil, which is an amendment. You can do a new will, depending on how long it's been since you've done it. And sometimes there's other options that, like, what if I don't like the charity anymore and I got to change my will and pay for that again? There's sometimes other options we can do that gives you a little more freedom in naming your charities. And then there's always the worry of, I'm going to be gone. I won't see it. I won't know. And usually what I remind people of, if it's a charity important to you, it's probably important to your kids as well. And so your kids are going to see the impact of that gift. And so while you might not see it, the legacy or the plan will live on in that. It's also for larger gifts. A lot of charities are perfectly happy to sit down and talk to you before you pass. And I am having my power dip. So
Oh, I
can
hope we
someone?
don't lose our speaker.
I can still hear you. Can you hear me?
We can hear you.
Okay, good. So we have our Wi-Fi and battery backup, and it just went on, but the lights are back on, so I should be fine. But there's no storm nearby. It's just I live in the country, so hopefully we'll be fine. But if it does go down, I will do my best to log back in right away. Um, Anyways, I was talking about you'll be gone, so you won't see the impact. So a lot of charities, if you want to leave a large gift, they'd be happy to meet with you and talk to you about it and talk about what you want to do and what you want to see happen with that gift. And they might even sign an agreement with you so that you know before you die exactly what those funds are going to and what kind of a plan or implementation that is going to happen with it. And my big recommendation is if you're going to restrict the funds in your will, please always talk to the charity first. Because what you think you want them to do with it, they might not be able to accomplish, and then it might be in a situation where they can't accept the gift. So if you want to restrict it, then please talk to them. All charities always happy to receive undesignated funds. So here's some money, and you guys do what you need to do with it at the time. So let's talk about what a will is. It is a written document. That means pen to paper, ink on paper, that sets out your wishes after death. There's two different ways you can do it. One, you can do it in your own handwriting on a piece of paper and sign it. We don't need witnesses for that. Or it's done like computer typed, and then you need to have two witnesses. One of the most recent differences, though, is British Columbia is starting to accept virtual wills. So if you're out in BC, please look that up what you're doing. If you're anywhere else in Canada, must be paper. It must physical paper. And the paper must be kept. We have to have the original to be able to probate it. So in your will, the most important thing is naming your executor. That's the person in charge of everything, what they're doing, who gets what, all of that. Next important thing is who gets everything. And so that's the section that we focus on for the charitable giving and how you deal with that in there. But a lot of giving, not just for charities, but like, leaving stuff to your kids or stuff like that. That can be a very creative section. It can be as simple as everything to my spouse. When both of us die, then split it between my kids evenly. You may need to put a trust in there because maybe you have somebody underage or you have somebody who's disabled. That's all the kind of stuff that you're putting in there. You also provide for the payment of debts in your will. You can set out specific gifts, so 10,000 to this charity or 10,000 to each of my grandchildren, stuff like that. And then the portion of the remainder. I talk about it in percentages. That's not actually how I draft it, but that's just technically how I do it. But you divide it up into shares or percentages of who gets what. And that's after you've made all the payments, paid all the debts, taxes, all that jazz. So now to the nitty gritty stuff. So how can you benefit a charity in the grow in your will? So there's fixed amounts, a percentage or a share. You can do a mix of both. And then we'll talk about how you best do that. So fixed amount is either a set amount, so you say $10,000, or a specific asset. So all of my shares in Canadian Pacific and my CP. If you have shares in a private corporation and want to do some of those, that's fine too. You can also give specific assets. So I sometimes have people say, give all of my personal belongings, like all of my clothes to the local Goodwill or Habitat to Humanity for my furniture and things like that. So you can, when we say specific asset, it means that's exactly what it is. I'm going to get back to like when you give securities, but there's some added tax benefits when you give publicly traded shares directly to a charity. So a percentage or share would be like 1% of my estate, 50% of my estate, or, I have 4 kids, so add the charity as the fifth, so you're getting 1/5. But it can be any combination of any of that. And then you can do a mix, which I've done a bunch of times for my clients because, sorry, I have a tickle now. So a mix of both is when we can't predict how much is going to be left at the end of the day. So we look at their assets today and they tell me, well, what percentage would you want to give today? So say you're worth $100,000 and you wanted to give them 10%, which would be 10,000. So what we say is then I want to give 10% or $10,000, whichever is less. So then if your estate is worth less than 100,000, they only get 10%. And if the estate's worth over 100,000 when you die, they get the 10,000. So that's a way to mix the two. The best ways to do this, one of the reasons we say it's best to contact a lawyer is just to make sure you're drafting it correctly. One is that we have to make sure we name the charity properly. So a lot of the time, what you know your charity as is not necessarily their legal name. And so a good lawyer will go to the CRA website, look up the charity online, make sure we've got the name right, but also include the charitable registration number for the charity. So if the charity ever changed their name or modified it, the registration number would make us know which one it was, and we'd be able to find them that way. On my wills, I actually put their corporate address on there too, just in case, because it just makes it easier for whoever's dealing with the will on the administration side. It also makes sure that because I took the CRA website, I'm making sure they're a registered charity. So I have some clients who've asked to leave money to like a dog rescue place, but they've never registered. And so they're not going to get a tax receipt for that donation. It's just a gift at that point. And so it's always good to double check those things to make sure that if it's important to you to make sure you get that tax receipt, that you're giving it to an organization that's actually capable of giving that to you. The other reason I actually advise my clients to always check the CRA website is because on there are actually the tax filings and returns of your favorite charities. So you can actually see how much they're spending on programs or on admin or other things like that. And so I find with my clients when they're trying to decide between a bunch of different charities, I ask them to go look at that and see if that helps them make that decision. Sometimes they also just call them and have a conversation with them, see who wants to work with them to be able to make that plan with them. And then the last point I have on there is called a cypres clause. That's just Latin. It's a clause that is common to put into wills when you're dealing with charities. And what it does is give some discretion to your estate trustee. If, say, your charity of choice either doesn't exist anymore or amalgamated with somebody else, that person can then say, okay, that amalgamation completely changed the way they are now, so I'm not going to follow that through and give the gift to them because that's not what you wanted. Or say the amalgamation means they're doing the exact same work, so they can still give that gift to them even though they amalgamated with another charity. On the part where it says they don't exist at all, I always ask my clients which they prefer. If they don't exist at all, does the gift just call it lapse, which means it just disappears and the money goes back into the estate? Um, or you can give the discretion to your executor to find a charity that does the same work that the one that you wanted to leave to used to do, if they can. So as I said, I'm going to talk about outside of the will as well. So beneficiary designations is kind of a big way you can give to a charity outside of your will, but post after death. So the kind of products that can have a beneficiary designation are like life insurance, RSPs, or RIFs. There's also LIRAs and LIFs. They're all the same. They're not exactly the same thing, but all the similar thing. TFSA, which is your tax-free savings account. Segregated funds, and pension death benefits. So all of those products are held by some other company. Like they're either held by the life insurance company, they're held by your bank or your investment company, or the pension management company. So all of them have different ways that you change or make beneficiary designations. So you'd have to contact wherever the funds are held to ask for the beneficiary designation form and fill it in from there if that's what you want to do. It is possible to name the beneficiaries in your will as well, and that still goes outside your will. You don't have to pay probate on it or anything like that. In my practice, I do that most of the time, if not all of the time. And that's just because I prefer it because most of the time when my clients see me, they're not 100% sure what they actually put down. And so then I just do it in there and confirm it in there. Um, but the fun part about when you do it, say in your RSP, your RIF, or any of those, or in a pension death benefit, both pension death benefits and RSPs are taxable as income in your year of death. So if you had $1 million in RSPs when you die, you now have $1 million of income in your year of death. There's a spousal rollover, so it's only on the last die. So hopefully nobody just panicked when I said that. So it's on the last die, but that's a huge tax hit. But if you designated a charity for all of your RSP, then no tax hit because it's it's been designated to a charity. So that's how sometimes that can help with those situations. With all of them, doesn't matter. You're going to get a tax receipt. It's just how it affects your income taxes in that year of death. Segregated funds I find are relatively rare these days, but they still exist. And pension death benefits I also find are getting more rare because most of us have a defined benefit plan. Is that the right one? So you just get your amount and it ends when you die. There's only the paid up amount. So if you once you get past the paid up amount, you are there's not going to be a death benefit at that point. And then the other thing to know, whenever you're making a beneficiary designation, it doesn't need to be 100% to a charity. You can divide it up however you like. You can give half to the kids, half to a charity. You can name 10 charities, say 5 charities. You can be as creative as you like. I know that most of the time when you get these forms from institutions, it's a really small space you have to fill that in. And so you might have to deal with your advisor to be like, no, I want to do something more complicated than this. But just know, even though their form doesn't allow you to be complicated, you can be complicated. You can be as creative as you like with that kind of stuff. You just gotta take the time with your advisor to be able to go through that and do that. So, tax implications. Your estate can donate up to 100% of your income at the time of death, and the donation can be carried back 2 years and forward 5 years. So there's some timing issues. Whenever I'm dealing with the estate administration side of things and I see that there's a gift to a charity in the will, I let the executor know we got to do everything we can to make sure that we get that donation out the door as soon as we can because we want to take advantage. We want the um, biggest advantage of that tax receipt from them. If you sit on it for a couple of years, then you could have some negative consequences on how much you can use that for. So that's the only like urgency or important thing you look at. I also tell them just talk to your accountant right away so I know the deadlines. And so then we can make sure we're working towards meeting those and getting the money out to the charity so we can take advantage of that tax receipt. So in case people don't generally know, your estate is taxed in the same way as if you were when you were alive until it's wound up. So a lot of people think, oh, I'm dead. Why am I paying taxes? Because CRA wants to make sure they get every penny until it's out of your estate's hands. So usually the first tax return we do in your year of death is the big one. That's where there's big dollars owing, and then it's smaller after that. But we have to keep doing it until we distribute everything. As I mentioned, your RSPs, RIF, LIF, LIRAs, and pensions are all treated as income in your estate in your year of death, unless we have that spousal rollover. There's one other rollover, which if you have a disabled child and they have an RDSP, Registered Disability Savings Plan, we can also roll it over into there, and then there's no tax consequence on your RSP. And then a gift of securities can result in no capital gains. So hopefully everyone can follow me this. We have our regular income taxes, right? And we have our marginal rates. Then we have capital gains, which is not on income, it's on the increase in value of an asset. So our personal houses don't count to the principal residence exemption, but if you have a cottage or say you have stock, so let's do some easy math. Let's say you bought CP Rail at $100. And when you die, it's worth $200. So you have $100 gain. So we only tax half the gain. Yes, there was some proposals to not do that. That fell through and it's not happening. So we only tax half the gain at your marginal rate. So if you ever want a rule of thumb on the gain, just say 25% and you'll be close enough. So when that CP rail stock is sold, we owe $25 to the government. The rest of it is yours. When you gift a security directly to a charity, so you don't sell the CP stock first, you just transfer it directly to the charity, you get to have a tax receipt for that full value, and you're not seen as selling those shares, so you don't have your capital gain on that. So if you're looking at your assets and what to give a charity, you're going to get the most bang from your buck from either RSP, RIF, or LIF, or a pension, or from a gift of securities directly to the charity. And the gift of securities you can do during your lifetime. So if you don't need the income, like the dividends from that security, you can do that during your lifetime and get that tax receipt in the year that you want it for. But post death, we just make sure we take care of that for you.